I just went and looked at the biggest winners and losers of 2025, and the results were shocking. Some of these stocks doubled, and some collapsed so badly they wiped out years of gains. Today, I'll show you the 5 most notable winners and the 5 most notable losers, explain what happened, and most importantly, whether I think these trends continue into 2026. This list will include some high yield and high growth dividend stocks, plus some popular growth stocks you've likely been hearing a lot about, and some surprising winners that got crushed in the years prior. To put this together, I opened up the AI Analyst on dividenddata.com. I typed stock screener US stocks by 1-year price return, and it gave me the exact table I'll be using today. You can also filter by hundreds of different financial options, whether it's forward ratios like forward PE, or earnings per share growth rates, revenue growth rates, dividend growth rates, etc. But today I'm going to focus purely on the winners and losers in terms of 1-year price performance. By the way, if you like what you see and want to follow along, we have our Black Friday sale, which just went live for dividenddata.com. You can lock in 50% off annual membership and keep that discounted price for life. You will never be able to lock in this low of a price ever again. The link is in the description and pinned comment of the video. And by the way, this is much more than a stock screener. You get access to 30 plus years of financials with great data visualizations that instantly let you understand the fundamentals of a business at a glance. But that leads us to our number 1 loser of 2025, a company that has no fundamentals. And compared to their valuation, they basically don't have a business. That is MicroStrategy, now named Strategy, ticker symbol MSTR. They were down over 55% on the year. Now, ironically, MicroStrategy was actually one of the biggest winners of 2024. And even after going down 57%, the 3-year price return is still 840%. And this company is valued just under $50 billion. But as you can see, this stock has fallen off a cliff since July. And if you're a more typical stock market investor, you would be quite concerned if you look at their financials. The actual business of Strategy, formerly MicroStrategy, they have about $450 to $500 million of annual revenue, and it's been like that for a decade. So it's really a no-growth business, and they have completely pivoted to being a Bitcoin holding company. And far more than that, they're a leveraged Bitcoin holding company. So their stock price will largely follow the momentum within Bitcoin prices. And in terms of value creation, I guess so far it's worked out. They've issued a ton of shares to raise capital, and then they transferred all that to Bitcoin. They also raised a ton of debt. They now have over $8 billion in net debt. As of November 2025, they own approximately 649,870 Bitcoins. And their average acquisition price is around $74,433 per Bitcoin. So that's more than 3% of the total 21 million Bitcoins that will ever be mined. And the bull and bear case here, it's pretty obvious. If you're a big Bitcoin bull and you think it's going to go up, then MicroStrategy will do quite well. The bear case would be that Bitcoin crashes and has a much lower price for a prolonged period of time. If you're analyzing MicroStrategy, there's no real business there. It's just an analysis on Bitcoin, and they own a crap ton of it. Bitcoin is down 10% over the past year, and it's down 30% from its 2025 high. So that's why Strategy stock is down. This one I'm going to leave to you. Whatever you think your opinion on Bitcoin is, that's your opinion on MicroStrategy. Now let's get to the real businesses and the winners of 2025. Number 1, Robinhood Markets, ticker symbol HOOD. This stock went up over 200% in 2025. Robinhood is now worth over $100 billion. And the stock's actually sold off from its 52-week high of $152 a share. We are currently at $115. So what happened? Robinhood had record profits in 2025. They just had an all-time high in quarterly earnings per share. And after a fiscal 2024 of profitability, they were profitable once again and increased those profits by a wide margin. Robinhood also grew revenue significantly. In fiscal 2024, they grew revenue per share by just under 60%. And they have far exceeded that in the first 3 quarters of 2025. And as you can see, they're on a prolonged trend of growth. They just hit record revenue per share. That was $1.27 billion in the latest quarter. If we take a look at their free cash flow, they are free cash flow positive for fiscal 2025. Robinhood's a high margin business. They got 82% gross margins, and they're hovering around 40% net margins right now. They're starting to build up some cash. They have $14.6 billion in cash and short-term investments. And Robinhood is not necessarily a traditional value play right now. It's more of a growth stock. And a large reason for the run-up in stock has to do more with the story around the company, the product releases, and expectations for the future based on their new market position. Robinhood is much more than the day trading app it once was. It's now become, for the younger generation, it's pretty much the brokerage of choice. They definitely have the best mobile app experience. They make it the most simple for people to get into investing. And the one thing they have going for them is that the traditional financial institutions, they are pretty slow to innovate. Robinhood is a very talented tech company, and their product velocity is incredibly high. They're expanding Robinhood into like everything. As an example, prediction markets that surpassed $100 million in annualized revenue, that's tracking to a $300 million run rate. They're creating ways for people to invest in private companies. They're doing tokenization of companies, a Robinhood banking. They're adding a form of social network into the platform. And the biggest one right now, in my opinion, and a big reason why it went up in 2025 is because of Robinhood Gold. This is a premium subscription that the company offers, and they have 3.9 million subscribers in the latest quarter. And that's over 14% of their overall customer base. And other revenues for the company, which a large chunk of is Robinhood Gold, that increased 100% year over year to $88 million in the latest quarter. So if I was valuing Robinhood stock, a big part of my bull case would be around Robinhood Gold and that subscription business. So Robinhood definitely is a real business. It will be around for a very long time to come. And the big part of the bull case for Robinhood is that as the younger generation starts to accumulate more and more wealth, and there's the great transfer of assets from the older generation to the younger generation, a lot of that money is going to go towards fintech platforms that the younger generation is on. And Robinhood is basically trying to be the everything personal finance and investing app. Loser number 2 is Chipotle, ticker symbol CMG. If you don't know, I'm actually a big Chipotle guy in terms of eating the food. That stock is down 50% on the year, and they are down even more from their all-time high in stock price back in June 2024. This stock used to be trading at $68.55. And historically, Chipotle has had fantastic growth in earnings per share, but they were trading at a high multiple. And all high multiples eventually come down if they can't back it up with growth in the fundamentals. And as we zoom into the 5-year, you can see that so far in 2025, they have not grown at a high rate. They've basically been flat. And likewise, you have seen the stock tumble. And for the first 3 quarters of fiscal 2025, they are flat in free cash flow per share, although this is still a very profitable business. And historically, it has had pretty good revenue growth. 5-year compound annual growth rate of revenue per share is 15.47%. And the top line is growing so far in 2025. As you're analyzing Chipotle stock, it all comes down to growth. Expectations for earnings per share growth have been revised down to 3% for the full year 2025. That puts it at a forward P ratio of 28.8. Analysts are projecting low growth in 2026, and then growth to re-accelerate in 2027 and 2028. And if you're investing in Chipotle stock, you need growth to re-accelerate into the double digits. Right now, analysts have a consensus price target of $43.75. That implies 30% upside from here. But right now, that's not happening. According to our earnings summary, Chipotle has been seeing comparable restaurant sales decline in the low single-digit range. And when you're analyzing restaurant stocks, comparable sales growth is a big thing that they focus on. By the way, this is all sourced from actual earnings calls transcripts and verified financial data. That's part of what makes the AI tool on dividenddata.com so great. It also has things like discount cash flows calculators where you can enter in the data yourself. And for a stock like Chipotle, it all comes down to the growth. So as a quick example, this isn't a full analysis. Let's say the company returns to 10% revenue growth annually. That's for fiscal 2028 and 2029. And the company trades at a 30 times free cash flow multiple. That would give an implied share price of $29.67, which is around the current stock price. It's about 4% off. If we think Chipotle can re-accelerate to 15% revenue growth in those later years, the implied share price goes up to $32.38. So no matter what way you crack it, this sell-off was pretty good for Chipotle. If you were planning to buy into the stock, it's definitely closer to fair value now. The second winner I'm going to share today is Palantir Technologies, ticker symbol PLTR. They were up over 150% on the year. And this isn't going to be a full stock analysis video on Palantir. I'm actually not like an expert on the company. I've done some research, but I haven't done a deep dive on it. And I know this is one that people are very passionate about. So I'm going to do more of a big picture financial look here. The big story with Palantir is that they are a leader in AI, and specifically at bringing it into the workflow of large corporations and large government entities. And they've kind of become the trusted partner in that. And they're pretty much the first mover and have been at this for a while. So let's get into the financials. As you can see, their earnings per share have been consistently growing every single quarter, and that growth is accelerating. That's part of the reason why the stock price is going up, because the growth is accelerating and it seems like it's going to continue. As an example, analysts are projecting over 30% annual earnings per share growth in 2026 and 2027, and Palantir bulls would say that's conservative. The same is true with their revenue growth as well. As you can see, their revenue per share growth has started to accelerate. It was up 17.7% quarter over quarter. This company is also free cash flow positive and growing. It's primarily a software company, so they have very high gross margins, 80% gross margins. And because they're consistently free cash flow positive, their balance sheet's pretty good. Their shareholder equity continues to grow quarter after quarter, just hit $6.59 billion. They have $6.4 billion in cash and short-term investments. And this company has very little debt, and that cash continues to grow. So in the latest quarter, that hit negative $6.2 billion of net debt. So the actual business of Palantir is pretty strong and in a good position to continue growing. But the problem actually has to do with the stock price and the valuation that the company trades at. Palantir is valued at $373 billion. And this is a company that for the full year 2025 is projected to generate $4.4 billion. So just to do some quick math for you, that means they're trading at 85 times sales, top line sales, not profit, sales. And if you have any kind of value investing background, you know that's insane. And to justify that level of valuation, you need to be growing rapidly. And Palantir has very high growth, but not to justify that. That valuation would make more sense if they were hitting 75% or 100% annual revenue growth, and they would have to keep hitting that year after year after year. Now, if you ask Palantir bulls why that's okay, they'll say something to the effect like they have such a dominant market position and very few direct competitors, so they will have a long runway of high growth. So the reliability of that future growth deserves a premium. But from my intuition, I don't see how at this valuation, if you were buying Palantir stock today, I don't see how that will do well over 5 to 10 years. The only way it would is if Palantir continues to accelerate revenue growth even more from this base. That's the bull case, that they continue to accelerate growth. That's what needs to happen if you're a Palantir shareholder. If they just stay how they've been doing, or if it levels off at all, the stock's going to get crushed. The number 3 loser of 2025 is actually a long-time dividend growth stock and something that a lot of value investors and super investors have been buying this year. That's UnitedHealth Group, ticker symbol UNH. That company is down 47% over the past year. This is the healthcare giant many of you are probably familiar with. They are highly controversial for their health insurance practices. No comment on that from me. But there's been a few big reasons why the stock has sold off this year. And one of them, all we have to do is scroll down and take a look at this. Their earnings per share have fallen off a cliff. And typically, if you're any kind of mature business and you see your earnings fall like this, I'll zoom in here so you can see even more. It got chopped by more than half. And likewise, you saw the stock price fall in that time. However, this has led to an attractive valuation for a company with historically consistent and high growth. Based on earnings per share over the trailing 12 months, so including these 2 lower quarters, but then also 2 of those higher quarters, they're trading a P ratio of 17. Now for the full year 2024, they're projecting earnings per share to come in at $16.32. That's a 40% decline overall. That would give it just under a 20 P ratio. So this is really the number we should be thinking of here. And whether or not this is a good buy really depends on whether or not they get back to those prior levels of earnings. And if they just do that, you have a pretty good value turnaround play. But then long term beyond that, if they can accelerate back to those 10% annual EPS growth years, analysts are projecting that in 2029, then this stock could probably crush it because that would give it a 2029 P ratio 10.7 based on today's stock price. And if it keeps growing beyond that, this could be a big compounder. UnitedHealth Group is a dividend growth stock. The current forward-looking dividend yield is 2.71%, and it's grown at a 10-year compound annual growth rate of 16%, which has slowed down with a 3-year CAGR of 10%. And based on at least the year prior's net income and free cash flow, that dividend was incredibly sustainable. 36% payout ratio based on free cash flow, and 52% based on GAAP net income. And while 2025 has been far worse, they did raise the dividend by 5.2% this year. This gives UNH stock one of its highest dividend yields ever. So if the company can turn around, this is a big value play. Prior to this sell-off, this company was a compounder in the market. The 4 years prior to that sell-off, 93% total return, 17.9% compound annual growth rate. And if we go back to 2011, the stock has a total return of 1,377%, or a 22% compound annual growth rate. And even if we include that 50% drop-off, it's still a 709% total return, 15.5% compound annual growth rate. No matter what way you crack the egg, UNH used to be a compounder in the market. I haven't done a full deep dive into their business. I'm not really a healthcare investor. I do think regulations also around healthcare policy in the US will kind of shape how the insurance business plays out. But in the status quo, UNH Group, probably a great value play. The number 3 winner I'm going to share today is Broadcom, ticker symbol AVGO. They are up 129% over the past year. And this company used to be a dividend growth favorite. Now the yields become very low, but that's because the stock price has run up a ton. The 3-year price return on Broadcom stock is 626%. And by the way, I just did a little bit of coverage on Broadcom stock in the video right before this one. I talk about both Google and Broadcom and why the AI trade is moving even more their direction. Now, the thing with Broadcom is that their valuation is getting quite high, and they're going to need many years of very high growth in their AI semiconductor business in order to justify this. Broadcom's overall earnings per share have started to grow in the past 5 quarters, but a large chunk of their business is not growing right now, and the majority of their business has nothing to do with AI, but they do have a specific AI-related business. They help create custom ASICs for companies. As an example, the Google TPU was a long-term partner of theirs. So that's part of the reason why the stock is up a ton with Google. Please go watch my recent video if you want a full breakdown into that reason. But the brief point here is that Broadcom's AI-related business, it's growing at a very high rate, and it's becoming a larger and larger part of Broadcom's business. So in the coming years, we should see their earnings per share really soar to new highs. But similar, but not nearly as severe as what I mentioned with Palantir, that growth is going to have to happen for many, many years. In the latest quarter, Broadcom's AI semiconductor revenue hit $5.2 billion, which was a 63% increase year over year. And that's going to grow by another $1 billion in Q4, which will be a 66% increase year over year. And Broadcom is expecting that growth to accelerate in fiscal 2026. So much higher than the 60% growth from a larger base. So that right there is the bull case for Broadcom. But they have to keep it up and keep growth going up because that valuation is already getting high. For context, if growth slows down at any point, the stock price is going to get killed. The company's stock price is even right around the price of Wall Street analysts, which have been having quite a bullish outlook on the stock. And part of the problem is that the AI market is really unpredictable of what the spend levels will be 4, 5, 6, 7 years from now. As an example, if you do a DCF valuation for Broadcom, we're already projecting 22% growth in 2025, 35 in 26, 31 in 27. If we think they can do 30% revenue growth in 2028 and 2029, in that scenario, Broadcom stock would be undervalued. This is assuming they trade at a 28 free cash flow multiple. But if that revenue growth goes down to something like 15, then the stock would be overvalued at the current price. And if the company stabilizes in those later years and doesn't see high growth, then the stock price would be significantly overvalued. Now, luckily, the thing that Broadcom has going for it, similar to NVIDIA, is that they're both fabless semiconductor companies and they focus on design. They outsource the manufacturing to TSMC. So what that means is their CapEx is way lower. They only have $500 million of annual CapEx. So virtually all of their cash they generate goes straight to free cash flow. $19.4 billion in fiscal 2024, and they just hit $7 billion in the latest quarter. That's expected to continue growing. So Broadcom is a free cash flow machine. And that does mean growing dividend payments, especially historically. I'd expect dividend growth to re-accelerate at Broadcom. 5-year CAGR, the dividend's only 12.67%, but I would expect some large dividend increases coming up on this one. So Broadcom does have some potential AI bubble risk, but overall deserves to be a winner for 2025. By the way, if you want to use the research tool I'm showing throughout, it's all available at dividenddata.com. We have our Black Friday sale where you can lock in 50% off annual membership, and you can keep that discounted price for life. We will never offer that low of a price locked in ever again. The link is in the description and pinned comment of the video. Let's get to loser number 4, and that is Adobe, ticker symbol ADBE. This software giant is down 39% over the past year. Now, the interesting thing with this stock price sell-off, it's been significant, and in terms of valuation, Adobe's looking very attractive. The other thing with Adobe is that their earnings have continued just marching upwards at the exact same rate. And this is a beautiful chart since they switched to being a subscription cloud company. Their earnings just have continually marched upwards. And that's why historically this stock crushed it and they traded at a very high multiple. But it was deserving because that's consistent, reliable subscription revenue growth and earnings and free cash flow. So based on earnings per share over the trailing 12 months, they now trade at a 19.9p ratio. and analysts are projecting continued double-digit earnings per share growth in the coming years. So if they continue to do that and hit this 2029 earnings per share of $29.73, that would be a forward-looking P ratio of 10.7, which is insane when you consider the company has growing earnings per share like that chart right there. The consensus analyst price target is $420 per share. That implies the stock is 31% undervalued based on today's price. So why is the stock down? I'll kind of give my answers around that, and I'll do a comparable stock that's also one of the biggest losers, and they have somewhat of a shared reason and bearish sentiment. But let's give Adobe its glory and go look at some of these financials. Revenue per share, so consistent. 5-year compound annual growth rate of 15.93%. Again, this quarterly revenue per share, annual revenue per share, it's beautiful, these charts. It's incredibly rare to find consistent growth like this. Adobe's a software business, so they have 89% gross margins. They have good bottom line too with 25% net margins. Adobe's free cash flow per share continues to grow. They just hit all-time highs in the prior year, and they're on pace to hit all-time highs so far in fiscal 2025. If we take a look at Adobe stock, this is the lowest PE ratio ever for the company, at least in modern history when they switched to that subscription cloud model. Right now, the forward PE ratio based on next year's expected earnings is 14. It's crazy. If we do a discount cash flow calculator for Adobe stock, and we just assume 10% revenue growth in the future years, the stock is 7.8% undervalued. But if we scroll down and we look at the fine print down here, this is based on an exit multiple of free cash flow of 12, which is the current one. But in my opinion, for a subscription software company like Adobe, that's a ridiculous free cash flow multiple. If we take a look at their lowest price to free cash flow in modern history since the 2015 switch, that was 21.9 in 2022. So we'll put in the lowest multiple it's traded at in prior years. All right, so we're updating that to 22. The implied share price for Adobe stock is now $542. That's 70% upside from here, and you could argue that's conservative. And if we go back to that list of losers for 2025, you'll notice down here that Salesforce, ticker symbol CRM, is also one of those losers. It's down nearly 32% over the past year. This is another subscription software company, and it and Adobe are the largest pure player software companies. So this says something about how the market is valuing software stocks. If you want my thoughts on Salesforce, I just covered that last week, but a lot of what I just said about Adobe, a lot of it applies to Salesforce as well. They're both fantastic subscription software companies. Their financials are awesome, really reliable high growth. Salesforce has great revenue per share growth, but both of these software companies are trading at a low multiple, and the reason is artificial intelligence, AI. And it's a two-pronged reason. On one side, they think there will be more competition possibly than ever because software development has become far more easier with these AI models. So there's a lot of potential for small startups taking away parts of their product portfolios. And it's becoming increasingly more possible for some of their more technical customers to actually build some of the products themselves. However, if you go and watch my Salesforce video I've made in the past, I think this is not that likely of an outcome. The more real current economic threat related to AI is actually seat contraction. Most of these software companies, they build their contracts based on the number of seats, so the number of employees at these companies. And in a potential AI future where you're hiring less or potentially laying off part of your workforce, you could be seeing seat contraction, which would be the exact opposite of seat expansion, which has been a big tailwind behind a lot of the growth of enterprise subscription software companies. I also think that is slightly overstated right now. And again, this is all just my opinion, not financial advice. Do whatever you think. Do your own research. I also think these businesses are a lot better than people are giving them credit for, and will show to have a lot more resilience than the market thinks. Winner number 4 for 2025 is Warner Bros. Discovery, ticker symbol WBD. It's up 119.8% on the year. Now, this one is interesting because the stock was not doing well at all until recently. The market actually completely hates media companies, and it hates Warner Bros. Discovery. But the only reason it's up is because of acquisition offers from Paramount Skydance. And the stock price has basically just gone up closer to where those acquisition offers are at. Now, the interesting thing is I actually think these assets are quite undervalued at most of the media companies, whether it's Disney or Warner Bros. Discovery. The market really hates the linear television assets because they're declining, but they do generate quite a bit of cash flow. And Warner Bros. Discovery did use that to pay off a bunch of their debt they got from that AT&T whole situation. $52.4 billion, and they have paid that down to $33 billion of total debt. And this company generates a lot of cash flow, $5.3 billion of operating cash flow, $4.4 billion of free cash flow in fiscal 2024. But this stock, it's kind of just a value play, and it's dead in the water outside of acquisitions. And this acquisition news is probably going to happen soon. Warner Bros. Discovery has asked potential buyers to submit improved offers by December 1st. And right now the offers are pretty much they're either going to merge the whole thing with Paramount Skydance, and financially that seems to be the best for shareholders. But there are also two other offers. We have one from Netflix and one from Comcast. But Netflix, they're only interested in buying the studio and streaming business. Comcast, on the other hand, they are also only interested in the studio and streaming business, but they have a more elegant solution with their cable TV business. Comcast is also in the middle of spinning out their cable networks, so Warner Bros. Cable networks could end up merging with that entity. So no matter what way you look at it, Warner Bros. Discovery, it's being sold for parts right now, and I think this largely has been priced into the stock. And this takes us right into loser number 5, which is Comcast, ticker symbol CMCSA. This is another dividend growth stock that's getting a higher yield. And by the way, I'll also cover a bonus high yield dividend stock, ONEOK, ticker symbol OKE. That is also down 37% on the year. But I'll talk about Comcast first. So Comcast stock has done terrible, sold off a ton. Forward-looking dividend yield is now 4.95%. This is the highest dividend yield ever in the history of Comcast, which could present a potential buying opportunity. The market absolutely hates this company. It trades at a ridiculously low multiple. Despite consistent earnings per share growth, they're going to have $123 billion of revenue this year. The current market cap's $97 billion. The consensus price target among Wall Street analysts is $35.59. That implies the stock is 29% undervalued. Been a consistent dividend growth stock. 5-year compound annual growth rate of the dividend is 7.49%, and it is sustainable with a 30% free cash flow payout ratio and 30% net income payout ratio. So I'm just being honest, on a surface level, this seems like a pretty good dividend stock to buy. Now, the big concern with investing in Comcast stock is their large amount of debt and some of their legacy businesses, things like their cable networks. They are in the process of spinning that out, though. Comcast has $89.7 billion of net debt and just around $100 billion of total debt. And if we do a DCF valuation for the company, the stock is just cheap. If we assume 0% revenue growth and that the company trades at 10 times free cash flow, the implied share price is $32. That's 19.9% upside from here. If we instead value it based on perpetuity and we assume just a 1% terminal growth rate, Comcast stock $71.90. 169% upside, but there are a lot more variables you can play around with. This is not a full stock analysis video. The other stock that was down a ton is ONEOK, ticker symbol OKE. They're down quite a bit from their all-time high. This is a midstream oil and gas stock. Many of you know that I like midstream oil and gas stocks. I've added quite a few to my portfolio. Gotten a few comments about this one. The dividend yield's now up to 5.81%. It's not a K1 tax form. Earnings per share are growing pretty good, and analysts are projecting future earnings per share growth. I'm not going to do a full analysis here, and I haven't done a deep dive on the company, but it is a consistent dividend payer. 3-year dividend CAGR is 3.28%. I thought I would provide it here as an honorable mention. On a surface level analysis, I definitely prefer my oil and gas stocks that I bought. That's HESM and MPLX. Again, not financial advice. Do your own research. This content is for educational purposes. And the final winner that I'm going to share today is Alphabet, ticker symbol GOOGL. This is the parent company of Google. They're up 91% over the past year. And if you want to know my thoughts on Google stock, well, lucky for you, I just made an entire video about it yesterday. So go and watch that video. This one's already running long, and I'm not going to be repetitive for my consistent viewers that already watched it. But Google stock is one of the best businesses in the world, and also a clear leader in AI, arguably the number one. And the market has finally started to price it fairly. It was significantly undervalued. Now it's trading closer to fair value. If you want to use the stock research tool I showed throughout, this is all available at dividenddata.com. The AI analyst with the stock screener and the DCF tool and the earnings summaries and really any question. The stock analysis tool with 30 plus years of financial data. A portfolio tracker where you can automatically add your account. And it has tools specifically designed for dividend-focused investors where you can get your projected income. If you want to try it out, now is the time to do so. We have our Black Friday sale where you can lock in 50% off annual membership. There's a 30-day money-back guarantee, so no risk in trying it out. The link is in the description and pinned comment of the video. And with that said, go watch my Google video I made yesterday. Thanks for watching, and I'll see you in the next one.